trade out of it and trade into the other assets that showed less volatility.
I see. And the other assets are what, the bonds or something else?
Bonds, exactly. Yeah.
Is the goal here to try to really reduce the chance of being hit by a black swan?
Yes.
Because what you're talking about sounds very similar to, I don't know if you heard of Nassim Taleb. He wrote the book on black swans, and he mentioned this as one of the strategies, the barbell approach.
Yeah.
Overweight, very conservative investments like bonds, and then maybe 80-90%, and then the 10 to 20% you put in much higher risk assets.
That's very much the theory behind it. You also this fund also tried to keep the drawdowns low, simply because of the mathematics behind it, right? Because if you have, for example, a 50% drawdown, you need 100. You need to make 100% just to get back at break even. Exactly. Yes.
So, what were some of the assets that the fund was investing in on the riskier side of the equation, with a smaller portion of the total assets, like individual stocks or options or what high risk type assets?
So this fund was quite straightforward in terms of assets, because this was basically the fund was just investing via ETFs into equities and into fixed income also via ETFs. So there were no leveraged products involved or derivatives.
During this time, you're also able to trade your personal account without any restrictions?
That was one of the reasons why I joined this company, because it was possible. For many other companies, it wasn't possible. So they already tell you this during the interview, that you cannot trade any of your positions, or you sometimes also have a minimum time horizon. For example, you have to be invested for at least 30 days in an asset, and you cannot hedge it, and so on. But here it was possible. That was one of the reasons why I joined the company as well.
Did you learn anything at the company that you later incorporated into your own personal trading?
At this company, not too much, because it was a very long-term strategy and it was mostly in equities and bonds. Where I worked later, I worked also at a proprietary trading company where they did quite a few short-term strategies, and that was a little bit of an eye-opener for me, especially in terms of with regards to my own strategy that I was using. Still,
tell us, why was it an eye-opener?
It was mostly an eye-opener because that's where I learned what it means to have. There's no official technical term for it, but mostly they refer to it, what it means to have a structural edge, which I would define as understanding your asset in such a way that you know where it's most likely going to go in the midterm and long term, especially. What does that mean? When you look at equity indexes, for example, if you look at the whole history, you will see that they mostly in the US tend to go up over time. If you take a very, very long-term view on the Canadian dollar versus the Norwegian crown, for example, and you plot the chart, you will see that it is highly mean reverting, which also fundamentally makes a lot of sense. Or when you look at the volatility futures, you see that over time, because of the futures decay, it's basically just a line that goes down on a chart. And this is something that they would call a structural edge, where you just know where long-term or mid-term the price of the asset is most likely going to go, completely independent of what the current fundamentals are. And that's something where I really learned it's not going to make sense to try and trade a mean reverting strategy or indicators on a trending asset. It's just not. It doesn't matter. You can tweak it however you want, but it's in the end, if you find something that is profitable, it's likely over optimized. That was basically the most valuable lesson that I really learned. That there's nothing more important than to have a structural edge and to really understand the asset that you're trading.
In our pre-call, you mentioned about part of the strategy, I believe, for yourself or at the fund, was to not reinvest the earnings, so as to help reduce the likelihood of getting blown up by a black swan by continually compounding. Could you go more into that?
Some strategies, when you backtest them, and you use, for example, a portion of your portfolio size as trading size. For example, you say you want to only risk 1% of your portfolio in every trade. The good thing is that you compound your returns. The bad thing is obviously your strategy always has to work very well in order for you to not have a very large drawdown of which you cannot come out, or you blow the or blowing up the account. If you try and trade a purely fixed size strategy, so you trade with in every trade you take exactly the same position size. Let's take let's talk about an example. If you have a strategy that on average per year can make you 50%, but it can also lose 100%. This is obviously a strategy that you cannot implement. However, if you trade this strategy over 2, 3, 4, 5, 10 years, let's say, after the first 2 years, if you made 2 times 50%, you're already up 100%. And since you are not increasing the trading size, even though your backtest show that maybe once every 10 years, your strategy has that 100% drawdown, you're already up 100%. So even if you have that drawdown, you will just be back at your initial equity. And you can trade out of that drawdown quite easily compared to if you would compound your returns, in which case, whenever you have a 100% drawdown, your account is gone because you're compounding the returns. You're using with every trade, you're basically risking your whole portfolio.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including zero commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
I'd like to dive into the subject of black swans. What what are black swans for our listeners in the financial markets? Why do they even call that?
So basically, black swans essentially are quite rare in real life. And that's basically also why this metaphor is used. Yeah, so black swans are basically just very events that are very rare, that can happen every once in a while. I guess one of the most recent and best examples is probably how assets traded during the Corona crisis, where we saw an incredibly sharp downturn, but at the same time, at a